Most people begin investing with expectations that sound reasonable on the surface. They imagine that once they start contributing money regularly, growth will appear quickly and steadily. They expect their investments to rise month after month, year after year, creating a smooth path toward financial freedom. But reality rarely follows this picture. Instead, growth appears slower, less predictable, and far more frustrating than expected. As a result, many people become discouraged long before their investments have a chance to reach their full potential. The reason your investments never grow the way you expect has very little to do with the investments themselves. In many cases, the problem lies in expectations rather than performance. Human beings naturally underestimate the role of time and overestimate the role of short-term results. We want progress now. We want visible proof that our decisions are working. And when that proof does not arrive quickly, doubt begins replacing confidence. This creates one of the most damaging patterns in investing. People start with optimism, then growth appears slower than anticipated. Frustration follows. Soon they begin searching for alternatives. They switch strategies, chase trends, move money around, or abandon investing altogether. Ironically, the behavior created by unrealistic expectations often becomes the reason growth never rises. One of the biggest misunderstandings involves compounding. Nearly everyone has heard the term, but very few people truly appreciate what it means in practice. Compounding is powerful precisely because it begins slowly. During the early years, growth appears modest. Small gains create slightly larger gains. Progress feels almost invisible. This is where many investors lose patience. The problem is that people expect compounding to feel dramatic from the beginning. They imagine exponential growth starting immediately, but compounding behaves differently. It starts quietly and accelerates later. The majority of its power appears after years of consistency. Unfortunately, many investors quit during the quiet phase and therefore never experience the acceleration they were hoping for. Another reason expectations fail is because people compare reality to stories instead of statistics. Social media constantly highlights extraordinary success stories. Someone doubles their money. Someone discovers a stock that explodes in value. Someone achieves financial independence far earlier than expected. These stories receive attention because they are unusual. What people rarely see are the millions of ordinary investors building wealth slowly over decades. Gradual success is not exciting enough to become viral, yet gradual success remains one of the most reliable paths toward financial security. When expectations are shaped by exceptional stories instead of normal outcomes, disappointment becomes almost inevitable. Market volatility also plays a major role. Many new investors assume growth happens in a straight line. They expect positive returns every year and sometimes every month. In reality, markets move through cycles. Periods of growth are often followed by periods of decline. Optimism is followed by fear. Expansion is followed by correction. These fluctuations are not signs that investing is broken. They are normal characteristics of investing itself. However, when people expect stability and encounter volatility, they interpret temporary declines as evidence that something has gone wrong. Fear begins influencing decisions. Contributions stop. Long-term plans are abandoned because short-term movements appear threatening. Smart investors understand something important. Temporary declines do not necessarily interrupt long-term growth, unless emotional reactions transform temporary setbacks into permanent mistakes. The market may recover. Lost patience rarely does. Another hidden reason investments fail to grow as expected involves contribution size. Many people focus exclusively on returns while ignoring the amount being invested. They spend years searching for better investments, when increasing contributions would have a far greater impact on future results. Consider two investors. One earns exceptional returns, but invests very little. The other earns average returns, but invests consistently and increases contributions over time. Decades later, the second investor often ends up in a stronger financial position. Why? Because investing success is driven not only by performance, but also by participation. The amount invested matters. The consistency of investing matters. The duration of investing matters. Returns matter too, but not nearly as much as most people assume. Many individuals also underestimate the effect of interruptions. Investing works best when allowed to continue uninterrupted. Every withdrawal, every pause, every emotional decision reduces momentum. Yet most investors experience multiple interruptions throughout their journey. They stop during recessions. They stop during financial stress. They stop when markets decline. They stop when fear becomes uncomfortable, then they restart later. Unfortunately, restarting repeatedly weakens one of the greatest advantages investing offers: time. Time rewards consistency. Every interruption shortens the period available for compounding. This effect is often invisible in the short term but enormous in the long term. Perhaps the biggest reason investments fail to grow as expected is that people expect investing to solve problems that behavior continues creating. They hope better investments will compensate for inconsistent habits. They hope higher returns will overcome poor discipline. They hope opportunity will replace patience. The wealth creation rarely works that way. Successful investing is usually less about finding extraordinary opportunities and more about maintaining ordinary discipline for an extraordinary amount of time. This truth feels almost disappointing because it lacks excitement, yet it remains one of the most important realities in finance. The investors who eventually achieve remarkable outcomes are often not the most intelligent, the most connected, or the luckiest. They are simply the ones who remain consistent when consistency becomes difficult. And that consistency begins with realistic expectations, understanding that growth may be slower than hoped, understanding that volatility is normal, understanding that compounding requires patience, understanding that wealth is often built quietly before it becomes visible. When these expectations align with reality, investing becomes far less frustrating and far more effective. Another reason your investments never grow the way you expect is because expectations are often built around outcomes rather than processes. Most people focus heavily on where they want to be financially. They imagine the future account balance, the future freedom, the future lifestyle, but they spend far less time thinking about the daily behaviors required to reach those outcomes. This creates a dangerous gap between dreams and actions. A person may want $1 million portfolio. They may want financial independence. They may want the ability to stop worrying about money. Yet if their investing behavior remains inconsistent, the desired outcome becomes increasingly difficult to achieve. Smart investors understand that outcomes are largely the result of systems. They focus less on goals and more on routines. Instead of obsessing over future wealth, they focus on present discipline. Instead of asking how much money they will have in 20 years, they ask whether they are investing consistently this month. This mindset seems simple, but it creates extraordinary differences over time. Another hidden factor involves impatience. Modern culture encourages people to expect rapid improvement in nearly every area of life. Technology becomes faster. Information becomes instant. Services become immediate. Because people become accustomed to speed, they unconsciously expect investing to operate under the same rules. But investing belongs to a different world. Investing rewards patience more than speed. It rewards consistency more than intensity. It rewards endurance more than excitement. This creates conflict because patience is emotionally uncomfortable. Waiting rarely feels productive. When progress appears slow, people begin questioning whether they are moving in the right direction. The temptation to change strategies becomes stronger. New opportunities appear more attractive. Existing plans begin feeling inadequate. Many investors spend their entire lives chasing what appears faster. Ironically, this constant pursuit of speed often slows progress dramatically. Every new strategy requires time. Every shift requires adjustment. Every change interrupts momentum. What feels like improvement may actually be restarting the process repeatedly. Smart investors understand that progress does not always feel exciting. In fact, successful investing often feels surprisingly boring. Contributions happen automatically. Portfolios grow gradually. There are no dramatic breakthroughs every month. The process lacks the emotional highs many people secretly crave. But this boring consistency is precisely what creates extraordinary long-term results. Another reason investments fail to meet expectations is lifestyle inflation. Many investors assume wealth comes from earning higher returns. While returns matter, spending habits often matter just as much. As income rises, spending frequently rises alongside it. New expenses appear. Standards increase. Luxuries become necessities. Financial pressure remains despite higher earnings, because lifestyle expands at the same pace as income. This pattern reduces the amount available for investing. As a result, portfolio growth remains slower than expected. Smart investors often behave differently. When income increases, they increase investments before increasing lifestyle. Additional earnings strengthen future wealth rather than immediately funding additional consumption. Over decades, This behavior creates enormous differences in financial outcomes. Many people also misunderstand risk. Average investors often define risk as losing money temporarily. Smart investors define risk more broadly. To them, the greatest risk is failing to achieve long-term goals because of short-term decisions. A temporary market decline may feel risky emotionally, but abandoning a long-term investment strategy because of fear can be far more damaging financially. This perspective changes how successful investors respond during difficult periods. Instead of focusing entirely on short-term fluctuations, they focus on long-term participation. They understand that remaining invested often matters more than timing investments perfectly. This is important because timing consistently is extremely difficult. Many investors believe they can move in and out of markets successfully. They hope to avoid losses and capture gains. While this idea sounds attractive, reality rarely cooperates. Missing just a handful of strong market periods can dramatically reduce long-term performance. Because of this, smart investors prioritize staying invested rather than constantly trying to predict the future. There is also a psychological factor that affects expectations. People naturally remember successes more clearly than failures. When markets perform well, investors imagine future growth continuing indefinitely. Expectations rise rapidly. Then when growth slows or declines occur, disappointment becomes inevitable because expectations were unrealistic from the beginning. The market does not exist to satisfy expectations. The market follows its own cycles. Understanding this reality allows investors to approach growth with greater patience and emotional stability. Perhaps the most important lesson is that investing rarely creates wealth in the way people imagine. Most people imagine a breakthrough. Real investing usually creates a build-up. The process resembles planting a tree more than winning a race. For years, visible progress may seem limited. The roots develop beneath the surface. Growth appears slow. Then eventually the structure becomes strong enough to support dramatic expansion. Investing often works the same way. The early years create the foundation. Consistent contributions build the base. Discipline strengthens the structure. Compounding gradually increases momentum. Then one day the results begin looking impressive, even though the real work happened years earlier. This is why many successful investors appear lucky to outsiders. People notice the outcome. They rarely notice the decades of consistency that created it. The truth is that your investments may already be growing, exactly the way successful investing normally works. The problem may not be the growth itself. The problem may be the expectation that growth should happen faster, smoother, or more dramatically than reality allows. When expectations become realistic, patience becomes easier. When patience becomes easier, consistency improves. When consistency improves, compounding gains strength. And when compounding gains strength, investments eventually begin producing the very results that once seemed frustratingly out of reach. That is the paradox of investing. The moment you stop expecting extraordinary short-term growth is often the moment you become capable of achieving extraordinary long-term growth.